This month has been an absolute roller coaster for growth stocks. Just when I think they can't go any lower, news comes out about inflation, interest rates, record low consumer sentiment, oh yeah, and border conflicts. Holy moly, the bad news never seems to end. Even if your portfolio looks like mine, I wouldn't panic sell just yet. In this episode, I'll show you what I've been buying since my last portfolio update, as well as why I made my biggest sale to date by selling all my Facebook stock. Your time is valuable, so let's get right into it. Let's start with my portfolio's performance. If you're relatively new to the channel, I started this portfolio the week that I hit 100,000 subscribers. That was about 3 months ago, which turns out was pretty much the worst possible time to start a growth-focused portfolio. Who says you can't time the market? Since November, I'm down about 21%. During that same time frame, the S&P 500 is down about 4%, the Nasdaq is down close to 10%, and the Russell 2000 is down a little over 13%. Since ARK Invest is one of the main focuses of this channel, one of my main goals of this portfolio is to try and outperform ARK-K, their flagship innovation fund. ARK-K is down over 40% since November.
I'm not even mad. That's amazing.
That's pretty crazy, but I want to stress that it has nothing to do with growth companies and everything to do with macroeconomics. How do I know that? Because many of the earnings reports and business updates from companies inside my portfolio and ARK Invest's portfolios have shown incredibly strong year-over-year growth, even when compared to the height of the pandemic. I'll never get better as an investor if I don't honestly assess my own performance. So, I'm doing better than ARK-K, but worse than every other major index out there right now, which means I need to do a better job protecting my downside. So I give myself a solid C-, and my job is to be much pickier with the next $50,000 I deploy. Speaking of which, I'm going to add another $50,000 to my portfolio over time. I'm doing this for a few reasons. First, the channel recently hit 150,000 subscribers, and I like the idea of the portfolio keeping up with my subscriber count. That stops me from trying to time the market. Whenever the channel hits a new milestone like this, I'll add money to the account, or at least as soon as I can. I'm definitely not actually made of money. Right now, I've added $20,000 to my portfolio, and I'll add the other $30,000 in as soon as tax season is over. Doing this also holds me accountable. I can't just bail when things get tough. And speaking of things getting tough, here's my portfolio organized by position size. As you can see, I'm basically down by 15 to 35% on everything. Yikes. Some questions I've been getting lately are how can I be so calm when I'm down by so much? Am I not worried that I'm underperforming the overall market? Nope. Let me explain. Upstart is a great company that I do owe you a deep dive on. It's a cloud-based lending platform that uses AI to assess and manage risk. In Q4, 70% of Upstart's loans were fully automated and instantly approved while fraud rates remained low. I'll leave a link to their most recent earnings presentation in the description below, but here's the thing. That earnings presentation is not about loans. It's a presentation about technology disrupting the traditional loans market. Upstart is now my second biggest position overall after it went up by 35% today. 35% in one day. Don't worry, knowing my luck, it'll be back down by the time you watch this, but my point is that each one of these companies has been doing awesome things that I strongly believe will keep catching Wall Street analysts by surprise. How much of a surprise? Well, Upstart surprised on earnings per share by 75% and on revenue by 16%. Why such a big surprise? Because most traditional Wall Street analysts and all trading algorithms are set to make apples-to-apples comparisons of numbers on balance sheets, not the underlying technologies driving those balance sheets over time. Here's another reason I'm not worried. Let me sort my portfolio by all-time gains so we can take a look at some of my biggest quote-unquote losers. It's no surprise that all of my biggest losers are high-growth fintech companies, since those are the exact kinds of companies that get punished twice by rising interest rates and reopening economies. First up is C Limited, which is also my biggest position by far. If we go to public.com's page on C Limited, we can see that it's actually 3 companies in one. Garena is their digital entertainment and gaming brand, Shopee is their e-commerce arm, and C-Money is their digital payment solutions. If each of these business units were a separate company, I'd have all 3 of them in my portfolio. I'm not kidding. Garena is the Southeast Asian publisher of some of the most downloaded games in the world, like League of Legends and Free Fire, which it also developed. Shopee becomes one of the dominant e-commerce channels in every country it touches, and C-Money is one of the fastest growing fintech units I've ever seen a company create. The fact that you not only get all 3 of these business units with one stock, but that they all talk to each other and share resources on the back end makes this my absolute favorite company to hold for the long term. I think that Sea Limited could, no kidding, be a $1 trillion company one day, and it's now down to $60 billion in market cap, meaning I think it can almost 20x from here. Will that take time? Absolutely. Can it go lower? Absolutely. In fact, it's getting crushed right now because India is banning Chinese-backed apps like TikTok, citing privacy and security concerns. Sea is based in Singapore, but Tencent owns a sizable stake in it. Garena's Free Fire is one of the apps that got banned, and investors are worried that Shopee will be banned as well. India is a big potential market for Sea Limited, and Sea's leadership has already responded to this ban, saying they're working to resolve the issues and that their apps already comply with India's privacy laws. Nevertheless, this is a real risk that you should know about, but I've been buying the dip. My second biggest loser is a company called Block, formerly called Square. Oh, you've heard of it? Block is now the parent company of Square, as well as Cash App, Tidal, and Spiral, which together form an ecosystem of banking, e-commerce, and cryptocurrency solutions for small and medium-sized businesses, as well as content creators. According to Spiral, Bitcoin is the best money and it should be used like it. Spiral aims to make Bitcoin the planet's preferred currency. So Square, or Block, or whatever we're calling everything under ticker symbol SQ these days, is an investment in end-to-end fintech ecosystems that won't get easily disrupted by crypto. In fact, an upcoming feature for the iPhone called Tap to Pay will allow merchants to receive contactless payments from other credit cards, debit cards, and digital wallets outside of Apple Pay. This is great news for iPhone users who use Cash App as their mobile wallet of choice. Square is currently ARK Invest's 8th biggest position, with almost $800 million invested in it across ARK-K, ARK-W, and ARK-F, even after Square's almost 60% drop over the last 3 months. I recently did a deep dive into Square versus PayPal, where I talked a lot more about that ecosystem that Square is building out. If you're interested in learning more about that, I'll leave that episode in the top right-hand corner of your screen right now, and in the description below as well. By the way, even though Square dropped 60% since I started my portfolio, I'm only down about 30% on it. That's the power of dollar cost averaging instead of dumping everything into a stock at once. Let's do one more. Stone, ticker symbol STNE, is my third biggest loser. Oh boy. Stone is a one-stop shop that provides small and medium-sized businesses in Brazil the fintech solutions that they need to move away from cash and join the digital economy. Stone has a point-of-sale solution that accepts credit cards, digital wallets, and QR codes, kind of like Square's payment terminal. In addition, they help businesses complete fully online transactions without any physical devices by generating payment links that can be sent to customers for quick and easy sales. Stone can support micro merchants and very small vendors without actual storefronts or websites, which greatly expands their total addressable market. That kind of scalability is important to long-term growth. However, fintech companies in emerging markets come with real risks. This is by far the riskiest stock in my portfolio, but one thing that eases my mind, beyond my own research, is that Warren Buffett and Cathie Wood both hold millions of shares of this stock. In fact, as of Warren Buffett's latest 13F filing just a few days ago, he hasn't sold a single share of Stone as it collapsed from over $90 per share to just $12 over the last year. If you want to know why I hold so much Stone stock and I'm continuing to buy the dip, I talked about it when I covered their most recent earnings call, and nothing has really changed my mind about Stone since that call. One thing I really love about Public.com is that they get everything about a stock together in one place, including news, upcoming earnings calls, previous earnings results, and even analyst price targets. Take a look at the consensus estimate for Stone's price right now. It's literally more than 10 times higher than Stone's actual stock price. Having all this information about a company in one place has been really handy for me, so I end up starting a lot of my research at Public.com and expanding out from there. Another thing I really love about Public is that they really focus on investor education and learning about companies, not just stocks. As a result, they end up featuring my deep dives on companies quite often, and my episodes on Stone are no exception. These are the reasons why I asked Public.com to be a sponsor for the channel. So whether you're looking for a new home for your own portfolio or you're just looking for a different way to support the channel, you can go to public.com/ticker-symbol-U and you'll receive a free slice of stock worth up to $70 when you fund your account. Public.com is free to use with no account minimum to get started, doesn't charge fees for standard trades, and allows you to buy slices of stocks for as little as $1. I'll leave a link to that exclusive offer for you in the description below as well. In each one of these portfolio updates, I try to include an exercise or an investing idea that costs absolutely nothing but pays off in big ways over time. Well, this month's idea is that it's okay to be wrong, but it's not okay to stay wrong. Here's what happened. Meta Platforms was one of my cash-like positions because I really believe that their IPs will help Mark Zuckerberg build some of the infrastructure to the Metaverse. I actually still believe that. What I did a bad job of doing is really thinking about the technical risks for Facebook today because I assumed that they were just too big to fail. Shame on me. That was a mistake. Long story short, back in June of 2020, Apple announced changes to iOS that would give iPhone users a chance to tell app makers not to track their behavior on the internet. See? This is why I use Android. Hey, wait. In Facebook's latest earnings call, which happened at the beginning of February, they really confirmed that they're unable to disentangle their business from tracking users in a world where people place a high value on privacy. I strongly believe that consumers and government regulators are going to keep privacy at the forefront of the technology debate, and smart companies should be proactive about getting as much value from as little personal data as possible. Facebook didn't do that, and when Apple made these changes, Facebook's shareholders paid the price, including me. It turns out that this privacy change will cost Facebook about $10 billion of revenue in 2022 alone, at a time when Mark Zuckerberg is trying to dump as much money as possible into building the Metaverse. Talk about burning a candle from both ends. You know who didn't suffer a $10 billion loss from this one iOS feature change? Google and Microsoft. Facebook stock was my third lowest position since I was still really trying to figure out which parts of their rebrand were fluff versus a real technical vision about the future of the internet. As you can imagine, that's not a quick task, so I let it stay at the bottom of my portfolio while I invested in the stocks that I can really wrap my head around. Well, I sold my huge, whopping 6 shares of Facebook for a combined $700 loss, and I bought Microsoft instead since I already own a solid amount of Google. I want to be clear that I'm practicing what I preach here. Here's where the system that I set up for this portfolio really saved me. I moved Microsoft from the top of my watch list to the bottom of my portfolio, and now Microsoft has to compete with every other stock in here for my money. Microsoft is a mega cap stock that is clearly vying for a big role in the metaverse and already has a ton of products and services that will benefit from its creation. In addition, Microsoft is currently working to acquire Activision Blizzard for a whopping $69 billion, which would be the biggest technology transaction in US history ever if it goes through. Also, if it goes through, Microsoft would then own some of the biggest gaming IPs in history, including World of Warcraft, Call of Duty, and Candy Crush. Comment below or tweet me at tickersymbolu if you want me to do a deep dive on Microsoft or Blizzard Activision or both. I think there are a lot of cool things going on here, and the more I learn about their CEO, Satya Nadella, the more bullish I get on this tech giant, especially if that Blizzard Activision acquisition completes. Connecting the bottom of my portfolio with the top of my watch list has saved me time and time again from buying too much of a stock that I'm bullish on, and Microsoft is just the latest example. If you want to follow along with my portfolio in real time instead of waiting for these monthly updates, consider supporting the channel as an insider tier patron on Patreon or channel member right here on YouTube. Supporters get access to a ton of exclusive written content, including my buy and sell alerts, monthly question and answer videos, and my thoughts on other news as it breaks. And if you're already a supporter of the channel, thank you. Your support makes this channel and projects like this public portfolio possible. If you want to learn more about how to keep your own portfolio safe from impulse buys and sells by connecting it to your watch list, check out this episode right here. Or if you want to learn more about some of my favorite growth stocks focused on artificial intelligence, including Microsoft, this is a great episode to check out next. Either way, stay long, stay strong, and thanks for watching. Until next time, this is ticker symbol U. My name is Alex, reminding you that the best investment you can make is in you.